What is debt financing? Debt financing is a way for firms to access capital for operations or investment, with various terms and agreements for future repayment. How is a debt obligation considered secured? A debt obligation is considered secured if creditors have recourse to the assets of the company on a proprietary basis or otherwise ahead of general claims against the company. What is public debt? Public debt is a general definition covering all financial instruments that are freely tradable on a public exchange or over the counter, with few if any restrictions. What is a syndicated loan? A syndicated loan is a loan granted to companies that wish to borrow more money than any single lender is prepared to risk in a single loan, usually many millions of dollars. What is unsecured debt? Unsecured debt comprises financial obligations where creditors do not have recourse to the assets of the borrower to satisfy their claims. What are the various types of debt used by companies to finance their operations? Companies use various types of debt, including secured and unsecured debt, private and public debt, syndicated and bilateral debt, and others. How are interest payments calculated in commercial loans? In commercial loans, interest is calculated as a percentage of the principal sum per year, which may be paid periodically or as a single payment at the end of the loan term. What is a bond, and who issues it? A bond is a debt security issued by certain institutions, such as companies and governments, to investors in a marketplace when they wish to borrow money. How is interest paid in bonds? Interest in bonds may be added to the end payment, or it can be paid in regular installments, coupons, during the life of the bond. Why are bonds considered relatively safe investments compared to equity? Bonds are considered relatively safe investments because they are lent to stable financial entities like large companies or governments and are less likely to be defaulted. What is a risk-free interest rate? A risk-free interest rate is the minimum return available in economics and is used in setting floating interest rates, usually with a bonus based on the debtor's creditworthiness. How is leverage defined in the context of debt and equity? Leverage refers to the proportion of debt to equity and is considered important in determining the riskiness of an investment. The more debt per equity, the riskier. What are some common uses of debt for individuals in industrialized nations? People in industrialized nations commonly use debt to purchase houses, cars, and other expensive items they cannot afford to buy outright. How does leveraging affect the return on equity for companies? Leveraging the investment made in assets can enhance the return on equity for companies. What factors contribute to the riskiness of an investment related to debt? The proportion of debt to equity, leverage, and the ability to service the debt can contribute to the riskiness of an investment. How can increased debt lead to poor results for individuals or companies? Increased debt can lead to poor results when the cost of servicing the debt becomes unmanageable due to external events, income loss, or internal difficulties. Poor resource management. In what situations is debt financing most beneficial for a company? Debt financing is most beneficial for a company when it can use the borrowed capital effectively to generate higher returns than the cost of servicing the debt. What are the potential risks associated with syndicated loans for borrowers? Syndicated loans carry the risk of a large exposure to multiple lenders, which could increase pressure on the borrower if they face financial difficulties. Why do investors consider U.S. Treasury securities as risk-free investments? Investors consider U.S. Treasury securities as risk-free because it is highly unlikely that the U.S. Treasury will default on its debt. How can a company reduce its risk in syndicated loans? A company can reduce its risk in syndicated loans by distributing the loan among multiple banks in a syndicate. What makes a syndicated loan different from a bilateral loan? A syndicated loan involves multiple lenders forming a syndicate, while a bilateral loan is a loan provided by a single lender. How do mezzanine obligations differ from senior obligations in private debt? Mezzanine obligations rank lower in priority compared to senior obligations in case of default, and they often carry a higher interest rate. Can you explain the term bullet loans in the context of debt financing? Bullet loans are a type of debt where there is only a single payment, the bullet, at the end without regular interest payments during the loan term. How can a company use debt financing to expand its operations? A company can use debt financing to secure capital for expansion, allowing it to invest in new projects, acquire assets, or enter new markets. What are the advantages of issuing public debt for a company compared to private debt? Public debt often provides companies with access to a broader range of investors and potentially lower interest rates compared to private debt. How can a company decide whether to issue debt or equity to finance its operations? A company can consider factors such as its current financial position, capital structure, and the cost of capital to determine whether to issue debt or equity. Why do some companies prefer private debt over public debt financing? Some companies may prefer private debt financing for greater flexibility, fewer regulatory requirements, and the ability to negotiate more personalized terms. In what circumstances would an organization choose to issue bonds instead of taking a bank loan? An organization may choose to issue bonds instead of taking a bank loan if it needs to raise a substantial amount of capital from a diverse pool of investors. What risks should investors consider when investing in bonds? Investors should consider credit risk, interest rate risk, and market risk when investing in bonds. How can companies manage their debt efficiently to avoid financial difficulties? Companies can manage their debt efficiently by ensuring that the cost of servicing the debt is manageable and they have a clear repayment plan. How do financial institutions determine the interest rate on loans? Financial institutions determine the interest rate on loans based on factors such as creditworthiness, market conditions, and the term of the loan. What are the potential benefits of using syndicated loans for borrowers? Syndicated loans can offer borrowers access to larger loan amounts, increased liquidity, and a diverse group of lenders. Can you give an example of a private debt instrument? A private debt instrument could be a loan extended by a private lender to a company for financing specific projects or operations. How do companies evaluate the riskiness of taking on debt? Companies evaluate the riskiness of taking on debt by analyzing factors such as their ability to generate cash flow, market conditions, and overall financial health. What factors may lead to a company defaulting on its debt obligations? Factors such as poor financial management, economic downturns, declining revenues, and excessive debt burden may lead to a company defaulting on its debt. How can a company determine the appropriate debt-to-equity ratio for its operations? Companies can determine the appropriate debt-to-equity ratio by considering their risk tolerance, growth prospects, and industry norms. What are the potential advantages of private debt for borrowers? Private debt can offer borrowers more flexible terms, a faster approval process, and the ability to negotiate terms directly with the lender. Can you explain the concept of a risk-free interest rate in more detail? A risk-free interest rate is the minimum return expected on an investment with virtually no risk of default, often exemplified by certain government securities. How does the term mezzanine in private debt financing relate to the overall risk of the investment? Mezzanine debt is subordinated to senior debt, making it riskier for investors, but potentially offering higher returns. What factors influence the interest rates on bonds? Interest rates on bonds are influenced by prevailing market rates, creditworthiness of the issuer, and the term and characteristics of the bond. How does a company's credit rating impact its ability to access debt financing? A higher credit rating enhances a company's ability to access debt financing at favorable interest rates and terms. What are the potential consequences of a company having a high level of debt relative to equity? A high level of debt relative to equity can increase the company's financial risk and may result in higher interest costs and reduced profitability. How can a company use debt financing strategically to gain a competitive advantage? A company can use debt financing strategically to invest in innovative projects, expand its market presence, or acquire competitors to gain a competitive edge. What are the key considerations for companies when choosing between long-term and short-term debt? Companies must consider factors such as the purpose of the borrowing, cost of borrowing, and their ability to repay when choosing between long-term and short-term debt. How do companies ensure they maintain an optimal capital structure? Companies maintain an optimal capital structure by balancing debt and equity financing to achieve the lowest overall cost of capital while managing financial risk. Can you explain the concept of a coupon rate in the context of bond financing? The coupon rate represents the interest rate on a bond and determines the periodic interest payments made to bondholders. What are the potential benefits of using debt financing over equity financing for a company? Debt financing allows a company to retain ownership and control while leveraging its operations, potentially resulting in higher returns for shareholders. How can a company protect its assets when issuing secured debt? A company can protect its assets when issuing secured debt by using collateral that creditors can claim in case of default. Why do some companies choose to issue bonds with long-term maturities? Companies may choose to issue bonds with long-term maturities to lock in lower interest rates for an extended period, reducing refinancing risks. What are some common risks associated with taking on debt financing? Common risks of debt financing include interest rate risk, credit risk, default risk, and refinancing risk. How can a company ensure it is using debt financing responsibly? A company can use debt financing responsibly by conducting thorough financial analysis, budgeting for repayments, and managing its debt-to-equity ratio. What measures can companies take to protect themselves from fluctuations in interest rates? Companies can use interest rate hedging instruments or seek fixed-rate loans to protect themselves from fluctuations in interest rates. Can you explain the concept of a sinking fund in relation to debt financing? A sinking fund is a pool of money set aside regularly to retire debt before its maturity, reducing the company's long-term debt burden. How does the maturity period of debt affect the overall cost of borrowing for a company? Longer maturity periods typically result in higher interest rates, increasing the overall cost of borrowing for a company. What are some disadvantages of relying heavily on debt financing? Heavy reliance on debt financing can lead to increased financial risk, higher interest costs, and reduced flexibility in times of economic downturns. How can a company negotiate better terms for its debt financing? A company can negotiate better terms for its debt financing by demonstrating strong financial performance, providing collateral, or seeking multiple bids from lenders. What impact can a company's credit rating have on its ability to issue bonds? A higher credit rating increases a company's ability to issue bonds at more favorable interest rates and attract a broader base of investors. How do companies assess their debt capacity before taking on additional debt? Companies assess their debt capacity by analyzing cash flow, debt-to-equity ratios, and projected future earnings. What are some potential risks associated with investing in bonds? Some potential risks of investing in bonds include interest rate risk, credit risk, inflation risk, and liquidity risk. How can a company utilize short-term debt effectively for its operations? A company can use short-term debt effectively to manage temporary cash flow shortages, take advantage of short-term opportunities, or meet immediate financial needs. Can you explain how companies use callable bonds in their financing strategies? Callable bonds allow companies to redeem the bonds before maturity, providing them with flexibility in managing their debt and refinancing options. What role do underwriters play in bond issuance? Underwriters facilitate the sale of bonds by purchasing them from the issuer and then reselling them to investors at a markup. How can a company assess the appropriate amount of debt to take on for a specific project? A company can assess the appropriate amount of debt by considering the project's cash flow projections and ensuring it can meet debt service requirements. What are the potential disadvantages of issuing bonds with longer maturities? Longer maturity bonds may face greater interest rate risk, and the company may have less flexibility in its capital structure. What factors may lead to a company refinancing its existing debt? Companies may refinance existing debt to take advantage of lower interest rates, extend the maturity period, or change the terms of the debt to better align with their financial goals. How do lenders assess the creditworthiness of companies seeking debt financing? Lenders assess creditworthiness by analyzing financial statements, cash flow projections, credit history, and the company's ability to service debt. Can you explain the risks associated with investing in mezzanine debt? Mezzanine debt carries higher risks due to its subordinated position and lower priority in case of default. What role do interest rates play in determining the cost of servicing debt for borrowers? Interest rates directly impact the cost of servicing debt, with higher rates leading to increased interest expenses for borrowers. How can a company use its credit rating to negotiate better terms with lenders? A higher credit rating can give a company leverage to negotiate lower interest rates and better terms with lenders. What are some common uses of mezzanine financing for companies? Companies may use mezzanine financing for acquisitions, expansion projects, or to bridge the gap between equity and senior debt. Can you explain the term risk-free interest rate in relation to government securities? The risk-free interest rate refers to the yield on government securities, which are considered low-risk investments. How can a company maintain a healthy balance between debt and equity in its capital structure? A company can maintain a healthy balance between debt and equity by regularly reviewing its financial ratios and capital needs. What are some advantages of using bilateral loans over syndicated loans for borrowers? Bilateral loans may offer more customized terms and conditions, and the borrower deals directly with a single lender. Can you explain the term coupon payment in relation to bonds? A coupon payment refers to the periodic interest payment made to bondholders during the life of a bond. How can investors assess the credit risk of a bond before investing? Investors can assess the credit risk of a bond by reviewing the issuer's credit rating, financial statements, and overall financial health. What role does collateral play in secured debt financing? Collateral provides lenders with recourse to specific assets of the borrower in case of default, reducing the lender's risk. How do financial institutions determine the creditworthiness of potential borrowers? Financial institutions determine creditworthiness by analyzing credit scores, income levels, debt-to-income ratios, and payment history. How can a company use a sinking fund to manage its long-term debt obligations? A sinking fund allows a company to set aside funds regularly to retire its long-term debt before the maturity date. Can you explain the concept of debt covenants in the context of debt financing? Debt covenants are contractual agreements that set specific terms and conditions for borrowers, designed to protect the lender's interests. How do companies determine the appropriate coupon rate for a bond issuance? Companies determine the appropriate coupon rate by considering market conditions, credit rating, and the level of risk associated with the bond. What are the potential benefits of using floating interest rates in debt financing? Floating interest rates provide borrowers with more flexibility as they can adjust to market changes, and they may offer initial lower rates compared to fixed rates. Can you describe the benefits of using bonds to finance government projects? Bonds allow governments to raise funds for public projects without depleting their current revenues and provide investors with a secure and stable investment option. What factors may lead to changes in interest rates in the financial markets? Changes in economic conditions, inflation rates, central bank policies, and global events can influence changes in interest rates. How can a company use debt refinancing to improve its financial position? Debt refinancing can lower interest expenses, extend maturity periods, and improve debt terms, thereby enhancing a company's financial position. Can you explain how a company's debt-to-equity ratio affects its financial leverage? A higher debt-to-equity ratio indicates greater financial leverage, meaning the company relies more on debt financing than equity. What are some factors that may influence the decision to issue convertible bonds? The decision to issue convertible bonds is influenced by factors such as the company's need for capital, market conditions, and investor demand. How can a company use a revolving credit facility to manage its short-term financing needs? A revolving credit facility provides a company with access to a pre-approved line of credit, allowing it to borrow and repay funds as needed. Can you explain the concept of bond yield and its importance to investors? Bond yield represents the return on investment for bondholders, and it is crucial for investors to assess the profitability of their bond investments. What role does the secondary market play in the bond market? The secondary market allows investors to buy and sell existing bonds after the initial issuance, providing liquidity to bondholders. How can a company use short-term debt strategically to take advantage of opportunities? Short-term debt allows a company to quickly access funds for time-sensitive opportunities, such as inventory purchases or short-term projects. Can you explain how companies use debt securitization as a financing strategy? Debt securitization involves converting debt assets into tradable securities, allowing companies to raise. How can a company use debt financing to fund acquisitions of other companies? Debt financing can provide companies with the necessary funds to acquire other companies, leveraging the assets of the acquired company for future growth. Can you explain how companies use debt restructuring to avoid bankruptcy? Debt restructuring allows companies to negotiate with creditors to modify debt terms and avoid bankruptcy by managing financial distress. Describe the concept of credit risk and its importance for bond investors. Credit risk refers to the risk of an issuer defaulting on its debt obligations, which is a significant consideration for bond investors. Discuss the potential benefits of using debt financing for green energy projects. Debt financing allows green energy projects to secure funding for renewable energy initiatives, contributing to sustainability and environmental goals. How can a company use debt financing to expand its production capacity? Debt financing can provide the necessary funds to invest in new production facilities, machinery, and equipment to increase production capacity. What factors may lead a company to issue bonds in international markets? Companies may issue bonds in international markets to diversify their investor base, access larger pools of capital, and take advantage of lower borrowing costs. Describe the potential benefits of using debt financing for educational institutions. Debt financing allows educational institutions to fund infrastructure upgrades, research initiatives, and student services without relying solely on tuition revenue. Discuss the potential impact of currency fluctuations on debt financing for international companies. Currency fluctuations can affect the cost of servicing foreign-denominated debt for international companies, introducing exchange rate risk. How can a company use debt financing to fund inventory expansion in retail businesses? Debt financing can provide retail businesses with funds to increase their inventory levels, allowing them to offer a broader range of products to customers. Explain the concept of debt issuance costs and their treatment in financial reporting. Debt issuance costs represent the expenses incurred by companies when issuing debt, and they are typically amortized over the life of the debt. Describe the potential benefits of using debt financing for healthcare facilities and medical research. Debt financing can enable healthcare facilities to invest in advanced medical equipment, infrastructure, and research to enhance patient care. Discuss the potential impact of changes in the stock market on the cost of equity financing for companies. Changes in the stock market can influence investor sentiment and affect the cost of equity financing for companies through changes in stock prices. How can a company use debt financing to fund technology upgrades and digital transformation? Debt financing can provide companies with the capital needed to invest in technology upgrades and digital transformation initiatives. Can you explain how companies use debt restructuring to improve their debt maturity profile? Debt restructuring can involve extending debt maturities, allowing companies to match debt repayments with cash flow and financial capabilities. Describe the concept of debt-to-capital ratio and its significance for financial analysis. The debt-to-capital ratio measures the proportion of a company's capital structure that is financed by debt, helping assess its financial risk. Discuss the potential benefits of using debt financing for nonprofit organizations. Debt financing can provide nonprofit organizations with funds to support their missions and expand their programs and services. How can a company use debt financing to fund research and development in the pharmaceutical industry? Debt financing can enable pharmaceutical companies to invest in research and development to discover and develop new drugs and treatments. Explain the concept of credit risk premium and its importance for investors. The credit risk premium represents the additional yield investors demand to hold riskier bonds with lower credit ratings. Describe the potential benefits of using debt financing for transportation infrastructure projects. Debt financing can help governments fund transportation infrastructure projects, such as highways and public transit systems, to improve connectivity and mobility. Discuss the potential impact of changes in the regulatory environment on the cost of debt financing for companies. Changes in the regulatory environment can influence borrowing costs for companies by affecting interest rates, compliance requirements, and investor confidence. How can a company use debt financing to fund sustainability initiatives and reduce its environmental footprint? Debt financing can provide companies with funds to invest in sustainable practices, renewable energy projects, and eco-friendly initiatives. Can you explain how companies use debt-for-equity swaps to improve their financial structure? Debt-for-equity swaps allow companies to convert debt into equity, potentially reducing debt levels and improving their financial stability. Describe the potential benefits of using debt financing for cultural and arts organizations. Debt financing can help cultural and arts organizations fund exhibitions, events, and educational programs to enrich communities. Discuss the potential impact of geopolitical events on interest rates and debt financing. Geopolitical events can cause fluctuations in interest rates, affecting the cost of debt financing for companies and governments. How can a company use debt financing to fund employee benefits and welfare programs? Debt financing can provide companies with funds to invest in employee benefits, wellness programs, and initiatives to enhance employee satisfaction and productivity. What is the alternative to debt financing when a company needs to raise capital? The alternative to debt financing is equity financing, which entails issuing stock to raise money. How does debt financing differ from equity financing in terms of repayment? Debt financing must be repaid, while equity financing does not need to be paid back. What are some examples of fixed income products used in debt financing? Fixed income products used in debt financing include bonds, bills, or notes. Why do small and new companies often rely on debt financing? Small and new companies rely on debt financing to buy resources that will facilitate growth. How many ways can a company obtain financing when it needs money? A company can obtain financing in 3 ways: sell equity, take on debt, or use a hybrid of the two. What does equity represent in a company? Equity represents an ownership stake in the company. Who becomes the creditors in debt financing? Individuals or institutions who buy debt instruments become creditors. What do lenders receive in equity financing? Lenders receive stock in equity financing. What is the cost of debt in a company's capital structure? The cost of debt is the interest payment to bondholders. What are coupon payments in debt financing? Coupon payments are the interest payments made annually to bondholders. Define a company's cost of capital. The cost of capital represents the minimum return a company must earn on its capital to satisfy its shareholders, creditors, and other providers of capital. What does a company's investment decision rely on in relation to the cost of capital? A company's investment decision should always generate returns greater than the cost of capital. What is the formula for the cost of debt financing? KD equals interest expense X. 1. Tax rate. Why is the interest expense calculated on an after-tax basis in the cost of debt financing formula? The interest on the debt is tax-deductible in most cases, so it is calculated on an after-tax basis to make it comparable to the cost of equity. What metric is used to measure how much of a company's capital is financed with debt financing? The debt-to-equity ratio, D/E, is used to measure and compare debt financing in a company. How is the debt-to-equity ratio, D/E, calculated? D/E ratio equals total debt/total stockholders' equity. What does a low D/E ratio indicate? A low D/E ratio indicates a relatively low reliance on debt financing compared to equity financing. How do creditors view a low D/E ratio in a company? Creditors tend to view a low D/E ratio favorably, increasing the likelihood of obtaining future funding. What determines the rate of interest in debt financing? Market rates and the creditworthiness of the borrower determine the rate of interest. Why do higher interest rates compensate the borrower in debt financing? Higher interest rates compensate the borrower for the increased risk of default. What are covenants in debt financing? Covenants are rules regarding financial performance that borrowers must adhere to in debt financing. When is debt financing more advantageous than equity financing? Debt financing is often more advantageous than equity financing when it offers lower rates, especially in periods of historically low interest rates. What advantage does debt financing have concerning taxation? The interest on the debt is tax-deductible in debt financing. What happens to the present value of the company if too much debt is added? Adding too much debt can increase the cost of capital, reducing the present value of the company. What does equity financing provide to a company? Equity financing provides extra working capital with no repayment obligation. What is the main difference between debt? Ownership. An alternative method of financing is debt financing, such as issuing bonds. What is trade financing, and how does it contribute to a company's working capital? Trade financing provides the major part of a company's working capital and covers day-to-day operational needs. What does the cost of equity represent for a firm? The cost of equity is the return a firm theoretically pays to its equity investors, shareholders, to compensate for the risk they undertake by investing their capital. What do equity investors seek as a return on their investment? Equity investors seek dividends and or appreciation in the value of their investment, capital gain. How is a firm's cost of debt determined? A firm's cost of debt can be determined by observing interest rates in the capital markets. What is the main challenge in determining a firm's cost of equity? The main challenge is that a firm's cost of equity is unobservable and must be estimated. How does the cost of capital change as a firm's risk increases or decreases? As a firm's risk increases, its cost of capital also increases, and vice versa. Why do capital providers require an extra reward for investing in riskier investments? Capital providers prefer safety over risk and naturally seek higher returns as an incentive for investing in riskier ventures. How does a firm's cost of capital affect its financing decisions? A firm's cost of capital influences the choice between debt and equity financing for various projects or investments. What is the key difference between debt and equity financing in terms of repayment? Debt financing requires repayment of borrowed funds with interest, while equity financing does not require repayment but may involve the payment of dividends to shareholders. How does equity financing allow the original owners to reduce their holding in a company? Through equity financing, the original owners can sell part of the company to new shareholders, thereby reducing their ownership stake. What benefits do shareholders gain by owning shares in a company? Shareholders have the potential to receive dividends and participate in the company's ownership and decision-making. How does the cost of equity impact a company's capital budgeting decisions? The cost of equity is a key factor in determining the required rate of return for potential projects and investments. How can a company estimate its cost of equity? A company can estimate its cost of equity using various financial models and valuation techniques. What is the significance of the cost of equity for investors? The cost of equity helps investors evaluate the potential return on their investment in a company's stock. How does a company's cost of equity influence its stock price in the market? A higher cost of equity may lead to a higher expected return for investors, potentially affecting the stock price positively. How do lenders and equity investors differ in their expectations of returns? Lenders expect interest payments, while equity investors seek dividends and capital appreciation. Why is the cost of capital important for financial decision-making? The cost of capital helps companies assess the profitability and risk of various investment opportunities. How can a company use equity financing to fund expansion into new markets? Equity financing can provide the necessary capital to support a company's expansion into new markets. How does equity financing contribute to increasing shareholder liquidity? Equity financing allows shareholders to sell their shares on the stock market, increasing liquidity for investors. Why do lenders and equity investors demand different rewards for providing capital? Lenders seek lower risk investments and expect interest payments, while equity investors take on higher risk and seek returns through dividends and capital gains. How can a company determine the appropriate mix of equity and debt financing in its capital structure? A company can analyze its cost of equity and cost of debt to find the optimal capital structure that minimizes the cost of capital. What are the potential consequences of issuing too much equity for a company? Issuing too much equity may lead to excessive dilution of ownership and control for existing shareholders. How can equity financing benefit a privately held company that wants to expand? Equity financing allows privately held companies to raise capital from the public to fund their expansion plans. How does equity financing provide an exit strategy for early investors in a company? Equity financing allows early investors to sell their shares to the public or private investors, providing an exit strategy. How can a company maintain a balance between rewarding equity investors and meeting financial obligations? A company must carefully manage its dividend policy to balance rewarding equity investors with maintaining sufficient funds for other financial obligations. What factors influence the cost of equity for a company? Factors such as market risk, company-specific risk, and interest rates can influence the cost of equity. How can a company's cost of equity affect its valuation in the stock market? A lower cost of equity may lead to a higher valuation for the company in the stock market. How can a company improve its cost of equity to attract investors? Improving financial performance, reducing risk, and enhancing growth prospects can help lower the cost of equity and attract investors. What is the role of dividends in a company's cost of equity? Dividends play a role in determining the cost of equity, as investors consider the potential return from dividends when valuing a company's stock. How does the cost of equity influence a company's borrowing decisions? A higher cost of equity may lead a company to prefer debt financing to minimize the dilution of existing shareholders' ownership. How can a company communicate its cost of equity to investors and stakeholders? Companies can disclose their cost of equity through financial reports and presentations to investors and stakeholders. What is the significance of a company's cost of equity in mergers and acquisitions? The cost of equity can influence the valuation and terms of a company involved in a merger or acquisition. What are some potential risks associated with issuing preferred stock for a company? Issuing preferred stock may result in fixed dividend obligations and priority in liquidation, which could limit financial flexibility. How can a company manage its capital structure to optimize its cost of equity? Companies can adjust their capital structure by issuing new equity or repurchasing shares to optimize their cost of equity. How does the cost of equity influence a company's overall cost of capital? The cost of equity is one of the components that contribute to a company's overall cost of capital. How can a company use equity financing to fund expansions into international markets? Equity financing can provide the necessary capital to support a company's expansion into international markets, including setting up operations and marketing. What factors may lead to changes in a company's cost of equity over time? Changes in the company's financial performance, market conditions, and risk profile may lead to changes in its cost of equity. How can a company use equity financing to attract strategic investors or partners? Equity financing can be used to offer ownership stakes to strategic investors or partners, strengthening collaborations and alliances. What is the role of stockholders' equity in a company's financial statements? Stockholders' equity represents the residual interest in the assets of a company after deducting liabilities, and it is reported in the balance sheet. How can a company use retained earnings as a form of equity financing? A company can use retained earnings, which are accumulated profits, to finance its operations and investments. How can a company determine the right balance between debt and equity financing for a specific project? Companies can use financial models and sensitivity analyses to determine the optimal mix of debt and equity financing for a project. What factors may cause the cost of equity to differ among companies in the same industry? Differences in risk profiles, growth prospects, and financial performance can cause the cost of equity to vary among companies in the same industry. How can a company use equity financing to fund social responsibility initiatives? Equity financing can provide funds for companies to invest in social responsibility projects and initiatives that benefit communities and the environment. How does the cost of equity influence a company's capital allocation decisions? The cost of equity is a factor in deciding which projects or investments to undertake, as it affects the required rate of return. How can a company use equity financing to reward early investors and founders? Equity financing allows early investors and founders to monetize their investment by selling shares on the stock market or to new investors. What are some potential challenges companies may face when issuing equity in the public markets? Companies may face market volatility, regulatory requirements, and the need to disclose sensitive information when issuing equity in the public markets. How can a company use equity financing to fund sustainability and environmentally friendly projects? Equity financing can provide the necessary capital for companies to invest in sustainable practices and eco-friendly initiatives. How does the cost of equity differ from the cost of debt in terms of tax implications? Interest payments on debt are tax-deductible, which can reduce the after-tax cost of debt, while dividends on equity are typically not tax-deductible. How can a company use equity financing to fund employee training and development programs? Equity financing can provide companies with funds to invest in employee training and development, enhancing their skills and productivity. What role does the cost of equity play in a company's dividend policy? The cost of equity influences the level of dividends a company may choose to distribute to shareholders. How can a company use equity financing to fund technology upgrades and digital transformation? Equity financing can provide companies with the capital needed to invest in technology upgrades and digital transformation initiatives. Can you explain how companies use equity for debt swaps in their financing strategies? Equity for debt swaps allow companies to convert equity into debt, potentially improving their financial position and reducing debt levels. Can you explain how companies use equity restructuring to optimize their financial structure? Equity restructuring involves changing the ownership and capital structure of a company to improve financial efficiency and performance. How can a company use equity financing to fund inventory expansion in retail businesses? Equity financing can provide retail businesses with funds to increase their inventory levels and offer a broader range of products to customers. Can you explain how companies use equity buybacks as a financial strategy? Equity buybacks involve a company repurchasing its own shares from shareholders, which can improve stock value and reduce the number of outstanding shares. How can a company use equity financing to fund infrastructure projects and construction? Equity financing can provide funds for companies to undertake large infrastructure projects and construction initiatives. How can a company use equity financing to fund philanthropic initiatives and charitable donations? Equity financing can provide funds for companies to support charitable causes and contribute to philanthropic initiatives. Can you explain how companies use equity warrants as a financial instrument? Equity warrants give investors the option to buy additional shares at a predetermined price, allowing companies to raise additional capital. How can a company use equity financing to fund expansion into international markets? Equity financing can provide the necessary capital to support a company's expansion into international markets, including setting up operations and marketing. What is long-term debt financing, and how does it benefit firms? Long-term debt financing allows firms to access capital without diluting equity. It involves borrowing money through loans that are repaid over time, usually with interest. This form of financing is most suitable for startup or mature companies. What are the key components of debt financing? The key components of debt financing include the principal amount borrowed, the interest rate, and the specified period over which the borrower must repay the debt. In what situations is debt financing typically used? Debt financing is often used by startup companies and mature firms to raise capital for various purposes, such as expansion, investment, or operational needs. What are the potential advantages of issuing corporate bonds over obtaining bank loans? Corporate bonds may offer less restrictive loan terms, better interest rates, and considerable tax advantages compared to bank loans. Additionally, bonds do not dilute equity or ownership. What are the risks associated with debt financing? The main risks of debt financing include the possibility of bankruptcy in case of failure to make timely payments to lenders and increased uncertainty about future financing needs. Define the term bond in the context of long-term financing. A bond is a debt security issued by a company or government entity to raise capital. The issuer owes the bondholders a debt and is obligated to pay interest and repay the principal amount over time. How do fixed-rate corporate bonds differ from floating-rate corporate bonds? Fixed-rate corporate bonds have a constant interest rate until maturity, while floating-rate corporate bonds have an interest rate that varies based on an underlying index, such as LIBOR. Explain the role of interest rates in debt financing. Interest rates in debt financing determine the return for investors and creditors. Riskier investments may require higher interest rates to compensate for the increased probability of default. What is the potential advantage of debt financing from a tax perspective? Debt financing may have tax advantages as interest payments are often tax-deductible, reducing the firm's taxable income and benefiting both investors and the firm. What is the Miller-Modigliani theorem, and how does it relate to capital structure theory? The Miller-Modigliani theorem is a theory in financial economics that suggests that the capital structure of a firm does not affect its overall value in a perfect market with no taxes or bankruptcy costs. Describe the potential drawbacks of equity financing. Equity financing involves selling stocks and giving ownership stakes to shareholders. The drawbacks include the need to maintain consistent profits to satisfy shareholders and the higher cost compared to debt financing. How does debt financing allow a business to leverage a small amount of money into a larger sum? Debt financing enables a business to borrow a significant amount of money with the promise to repay it over time. This allows the business to access more capital than it currently has. What are the advantages of equity financing for a business? Equity financing does not require repayment like debt financing does. The funds raised through selling stocks do not need to be paid back, which can provide financial flexibility to the company. How does the cost of debt capital differ from the cost of equity capital? The cost of debt capital is the interest rate required by the lender, while the cost of equity capital is the expected return demanded by shareholders. How can the after-tax cost of debt capital be calculated? The after-tax cost of debt capital can be calculated by considering the interest rate and the corporate tax rate. Subtracting the tax savings from the interest expense provides the after-tax cost. What is the capital asset pricing model, CAPM, and how is it used to calculate the cost of equity financing? The CAPM is a model used to determine the expected return on equity financing by considering the risk-free rate, the company's beta, and the risk premium. Why is the cost of equity often higher than the cost of debt? Equity financing carries more risk for investors compared to lending money through debt, which is why shareholders typically demand higher returns. What factors can influence a company's decision between debt and equity financing? Various factors, including the company's risk profile, tax considerations, market conditions, and the availability of funding sources, can influence the choice between debt and equity financing. How does debt financing affect a company's financial discipline? According to capital structure theory. Capital structure theory suggests that taking on debt can increase a company's financial discipline by forcing management to work harder to ensure they can cover interest payments. Identify some situations where debt financing might be more advantageous than equity financing. Debt financing might be more advantageous when a company wants to maintain ownership control, needs capital for a specific project or expansion, or seeks to benefit from tax deductions on interest payments. Explain why debt financing can become a burden for smaller or newer businesses. Smaller or newer businesses might find debt financing burdensome because they have less established revenue streams, making it difficult to meet regular interest payments. How can a company find the right balance between debt and equity financing to optimize its capital structure? Companies can use financial models, such as the weighted average cost of capital, WACC, to compare different capital structures and find the most cost-effective mix of debt and equity financing. Describe the role of credit rating agencies in determining interest rates for corporate bonds. Credit rating agencies assess the creditworthiness of issuers and assign ratings based on their ability to repay debt. These ratings can influence the interest rates on corporate bonds. What are the potential consequences for a company if it takes on too much debt? If a company takes on excessive debt, it may face higher interest expenses, decreased financial flexibility, and an increased risk of bankruptcy. Differentiate between secured and unsecured debt in financing. Secured debt is backed by collateral, while unsecured debt does not require any specific assets as security. In case of default, secured debt holders have a claim on the collateral. How do interest rates affect the attractiveness of debt financing for investors? Higher interest rates can make debt financing more attractive to investors as they offer higher returns, but they can also increase the borrowing costs for the company. What measures can a company take to mitigate the risks associated with debt financing? A company can mitigate risks associated with debt financing by carefully managing its debt-to-equity ratio, maintaining sufficient cash reserves, and ensuring a reliable revenue stream. How can a company determine the appropriate level of debt financing to avoid excessive risk? A company can conduct a comprehensive risk assessment and analyze its cash flow and debt repayment capabilities to determine an appropriate level of debt financing. Why might a company opt for debt financing over equity financing when planning for a major expansion project? Debt financing can be more attractive for a major expansion project because it allows the company to raise capital without diluting existing ownership and may result in tax advantages. In what situations might equity financing be a preferable option for a company? Equity financing might be preferable when a company wants to avoid taking on additional debt, has a high level of confidence in its growth prospects, or seeks long-term investors. How can a company maintain a balance between debt and equity financing to minimize financial risks? A company can maintain a balance between debt and equity financing by carefully managing its capital structure and continually evaluating its financial needs. How can a company's capital structure influence its cost of capital and financial performance? A company's capital structure can impact its cost of capital, as well as its overall financial performance, by affecting interest expenses, tax implications, and shareholder expectations. Why might investors prefer corporate bonds over stocks as an investment option? Corporate bonds are often perceived as less risky than stocks because bondholders receive fixed interest payments and have a higher priority in case of bankruptcy. How can a company evaluate its cost of equity to determine an appropriate return for shareholders? A company can use the Capital Asset Pricing Model, CAPM, to calculate the cost of equity by considering risk factors and the expected return on the overall market. What measures can a company take to reduce the cost of equity financing? A company can improve its financial performance, enhance its credit rating, and communicate a strong growth strategy to investors to potentially reduce the cost of equity financing. How does a company's beta impact the cost of equity financing? A higher beta indicates higher volatility and risk, which can result in a higher expected return and, consequently, a higher cost of equity financing. What are the implications of a company's capital structure on its creditworthiness? A company's capital structure can influence its creditworthiness and credit rating, affecting its ability to secure favorable debt financing. What factors should a company consider when determining an appropriate level of debt financing for expansion purposes? A company should consider its current financial position, projected cash flows, debt repayment capabilities, and risk tolerance when determining an appropriate level of debt financing for expansion. How can a company's credit rating influence the interest rates it pays on debt financing? A higher credit rating indicates lower credit risk, leading to lower interest rates for debt financing, while a lower credit rating can result in higher interest rates. How does debt financing contribute to a company's capital structure? Debt financing adds to a company's liabilities, which, along with its equity, makes up the company's capital structure. What steps can a company take to enhance its creditworthiness and credit rating? A company can improve its creditworthiness by maintaining a strong financial position, consistent profitability, and a positive credit history. What are some of the advantages and disadvantages of using bank loans for debt financing? Advantages of bank loans include ease of access and potentially lower interest rates, while disadvantages may include stricter loan terms and requirements. How does the interest rate on a bond affect the cost of debt financing for a company? The interest rate on a bond directly impacts the cost of debt financing for a company as it determines the amount the company must pay in interest over the bond's term. What are the potential risks associated with relying heavily on debt financing for a company's operations? Relying heavily on debt financing can increase financial risk, making it more challenging for a company to meet its debt obligations and potentially leading to bankruptcy. How can a company determine the appropriate mix of debt and equity financing to optimize its cost of capital? A company can use financial models, such as the weighted average cost of capital, WACC, to determine the optimal mix of debt and equity financing that minimizes the overall cost of capital. How can a company maintain a good balance between debt and equity to ensure financial stability? To maintain a good balance between debt and equity, a company should assess its risk tolerance, cash flow projections, and potential financing needs before deciding on the appropriate mix. How can a company's credit rating affect its ability to raise funds through debt financing? A higher credit rating enhances a company's ability to raise funds through debt financing at favorable terms, while a lower credit rating may result in higher interest rates or difficulty in securing financing. What are the potential consequences for shareholders when a company issues additional equity to raise capital? Issuing additional equity can dilute the ownership stake of existing shareholders, potentially affecting their proportional ownership and share valuations. How can a company maintain investor confidence while raising funds through equity financing? A company can maintain investor confidence by communicating a clear growth strategy, demonstrating solid financial performance, and providing transparent information. What are some of the key factors that affect a company's cost of debt financing? Key factors that affect a company's cost of debt financing include prevailing interest rates, credit rating, and the perceived risk associated with the company's financial health. How can a company's creditworthiness influence its ability to secure debt financing from different sources? A company with a strong creditworthiness and high credit rating is more likely to secure debt financing from various sources at favorable terms. How does a company's financial stability influence its ability to secure debt financing? A financially stable company is perceived as less risky by lenders, making it easier for them to secure debt financing at favorable terms. Discuss the potential impact of a company's industry and business model on its capital structure decisions. Different industries and business models have varying capital structure preferences based on their revenue stability, growth prospects, and risk profiles. How can a company use debt financing to take advantage of expansion opportunities in a competitive market? Debt financing can provide the necessary funds for a company to invest in expansion opportunities, allowing them to stay competitive and grow their market share. Explain how a company's dividend policy might be influenced by its capital structure. A company's dividend policy may be influenced by its capital structure as it affects the availability of funds to distribute to shareholders. What steps can a company take to protect its shareholders' interests when issuing additional equity? A company can protect shareholders' interests by clearly communicating the reasons for issuing additional equity, demonstrating growth prospects, and providing transparency in financial reporting. Discuss the potential effects of inflation on a company's cost of debt financing. Inflation can lead to higher interest rates, potentially increasing a company's cost of debt financing. How can a company assess its risk tolerance and financial stability when making debt financing decisions? A company can assess its risk tolerance and financial stability by analyzing its cash flow projections, debt service capabilities, and potential scenarios for business performance. Provide examples of some long-term financing options available to companies. Long-term financing options include issuing bonds, securing bank loans with long maturities, and obtaining long-term credit from institutional lenders. How might a company's historical financial performance impact its ability to secure debt financing? A company's historical financial performance can influence its ability to secure debt financing by demonstrating its ability to meet debt obligations and manage risk. Discuss the potential impact of a company's debt-to-equity ratio on its cost of capital. A higher debt-to-equity ratio generally leads to higher financial leverage and a higher cost of capital due to increased financial risk. How can a company use debt financing strategically to pursue mergers and acquisitions? Debt financing can be used strategically to fund mergers and acquisitions, allowing the company to expand its market presence and enhance shareholder value. Explain the potential implications of taking on too much debt for a company's overall financial health. Taking on too much debt can increase financial risk, lower credit ratings, and lead to potential insolvency if the company cannot meet its debt obligations. What are some alternatives to traditional debt financing that companies can explore? Companies can explore alternative financing options, such as lease financing, factoring, or venture capital, to raise capital without taking on traditional debt. Describe the potential consequences for a company if it relies solely on equity financing for all its capital needs. Relying solely on equity financing may limit a company's ability to take advantage of growth opportunities, as it may not have access to sufficient funds for expansion. How does a company's financial health influence its ability to negotiate favorable terms for debt financing? A financially healthy company with a strong credit rating is in a better position to negotiate favorable terms for debt financing, including lower interest rates. Discuss the potential impact of interest rate changes on a company's cost of debt financing. Interest rate changes can directly impact a company's cost of debt financing, as higher interest rates result in increased borrowing costs. How can a company manage its debt levels to maintain financial flexibility and minimize financial risk? A company can manage its debt levels by carefully evaluating its debt-to-equity ratio and ensuring that debt obligations are within its capacity to repay. How can a company strike a balance between debt and equity financing to minimize financial risks while supporting growth? A company can strike a balance between debt and equity financing by analyzing its financial position, evaluating risk tolerance, and considering its long-term growth plans. How can a company use its capital structure to achieve an optimal balance between debt and equity financing? A company can achieve an optimal capital structure by evaluating the cost of debt and equity financing and identifying the mix that minimizes the overall cost of capital. What measures can a company take to increase its financial flexibility through capital structure decisions? A company can increase financial flexibility by maintaining a healthy balance between debt and equity financing, avoiding excessive leverage, and ensuring sufficient cash reserves. How can a company strike a balance between taking on debt and maintaining an acceptable level of financial risk? To strike a balance, a company can set a target debt-to-equity ratio based on its risk tolerance and ensure that it can comfortably service its debt obligations. How can a company use debt financing strategically to fund research and development initiatives? Debt financing can be used strategically to fund research and development initiatives, enabling a company to innovate and improve its product or service offerings. How can a company assess its debt capacity when considering debt financing options? A company can assess its debt capacity by evaluating its current debt levels, cash flow projections, and potential risks associated with taking on additional debt. How can a company manage its debt-to-equity ratio to balance its capital structure effectively? A company can manage its debt-to-equity ratio by considering its borrowing needs, maintaining sufficient equity, and avoiding excessive debt levels. How can a company use its capital structure to align its financing decisions with its long-term growth strategy? A company can use its capital structure to ensure that its financing decisions support its long-term growth objectives and provide the necessary funding for expansion. How can a company use debt financing to fund strategic acquisitions and diversification efforts? Debt financing can provide the necessary funds for a company to pursue strategic acquisitions and diversification initiatives, enabling it to expand its product/service offerings. How can a company use debt financing to manage its cash flow and working capital requirements? Debt financing can help a company manage its cash flow and working capital requirements by providing immediate access to funds without using existing cash reserves. How can a company use debt financing to enhance its capacity for research and innovation? Debt financing can provide the necessary funds for a company to invest in research and innovation, enabling it to develop new products or services. How can a company use debt financing to increase its production capacity and market share? Debt financing can provide the necessary funds for a company to invest in expanding its production capacity and increasing market share. How can a company use debt financing to support its international expansion plans? Debt financing can provide the necessary funds for a company to expand internationally by investing in new markets and establishing foreign operations. How can a company use debt financing strategically to fund capital-intensive projects? Debt financing can be used strategically to fund capital-intensive projects, such as infrastructure investments or large-scale expansions, without depleting existing cash reserves. How can a company use debt financing to address short-term liquidity needs? Debt financing can provide a quick solution to address short-term liquidity needs, helping a company meet immediate financial obligations. How can a company use debt financing to optimize its capital structure and cost of capital? A company can use debt financing strategically to achieve an optimal capital structure that minimizes its overall cost of capital. How can a company use debt financing to fund sustainability initiatives and environmental projects? Debt financing can provide the funds needed for a company to invest in sustainability initiatives and environmentally friendly projects. How can a company use debt financing to optimize its working capital management? Debt financing can be used to optimize working capital management by providing immediate funds to support short-term operational needs. How can a company use debt financing to invest in employee training and development? Debt financing can provide the necessary funds for a company to invest in employee training and development programs, enhancing workforce skills and productivity. How can a company use debt financing to optimize its capital expenditure planning? Debt financing can help a company optimize its capital expenditure planning by providing funds for strategic investments and asset acquisitions. What is the primary advantage of equity financing for a firm? The main advantage of equity financing is that the business is not obligated to repay anything, as investors assume the risk in exchange for potential future profits. What is the main disadvantage of equity financing for a firm? The main disadvantage of equity financing is that it involves trading ownership stakes in the company for funds, which can lead to diminished control and autonomy for the managers. What type of stock has priority claims to assets in the event of liquidation and dividend payments? Preferred stock has priority claims to assets in the event of liquidation and dividend payments. When do common stockholders receive any remaining funds after liquidation? Common stockholders receive any remaining funds after bondholders, creditors, including employees, and preferred stockholders are paid in full. What voting rights do preferred stockholders typically have? Preferred stockholders usually lack voting rights in the company. What type of preferred stock allows holders to exchange it for a predetermined number of the company's common stock shares? Convertible preferred stock allows holders to exchange it for a predetermined number of the company's common stock shares. How are dividends on preferred shares typically specified? Dividends on preferred shares are usually specified as a percentage of the par value or as a fixed amount. Can common stock be converted back into preferred stock once it has been exchanged for the company's common stock shares? No. Once common stock is exchanged for the company's common stock shares, it cannot be converted back into preferred stock. What type of preferred stock offers holders the opportunity to receive extra dividends based on the company's financial performance? Participating preferred stock offers holders the opportunity to receive extra dividends based on the company's financial goals. What are the capital costs associated with equity financing? Capital costs associated with equity financing include accounting and legal costs, underwriting fees, and filing fees. What is the primary advantage of convertible preferred stock for investors? The primary advantage of convertible preferred stock for investors is the opportunity to convert it into common stock and potentially benefit from future price appreciation. In the event of bankruptcy, who has the riskiest investment among different stockholders? Common stock investors have the riskiest investment in the event of bankruptcy, as they are typically the last to receive any remaining funds after other stakeholders have been paid. What are the different types of preferred stock? The different types of preferred stock are cumulative preferred stock, non-cumulative preferred stock, participating preferred stock, and convertible preferred stock. What type of stockholders have priority in receiving dividend payments before common stockholders? Preferred stockholders have priority in receiving dividend payments before common stockholders. What is the formula for calculating the cost of preferred stock? Cost of preferred stock equals next dividend to be paid / current market value. 1. Flotation costs. How can preferred stockholders double dip in a liquidation event? Participating preferred stockholders can double dip by receiving their investment back and participating in the distribution of assets to common stockholders based on the proportion of common stock their preferred stock can be converted into. What are the key characteristics of common stock? Common stock represents an ownership interest in the company and typically comes with voting rights and the potential to receive dividends. What is the significance of voting rights for common stockholders? Voting rights allow common stockholders to participate in electing the firm's board of directors and influencing corporate policy decisions. What are the potential sources of equity financing for a firm? Equity financing can come from various sources, including friends and family, angel investors, venture capitalists, and public stock offerings. How does equity financing differ from debt financing? Equity financing involves selling ownership stakes in the company to investors, while debt financing involves borrowing funds that must be repaid with interest. What are the risks associated with equity financing for a company? The main risk of equity financing is the potential loss of control and decision-making power as new investors gain ownership stakes in the company. What is the key benefit of participating preferred stock for investors? The key benefit of participating preferred stock for investors is the opportunity to receive additional dividends based on the company's performance. What are the different types of investors who may provide equity financing to a firm? Investors providing equity financing may include friends and family, angel investors, venture capitalists, and institutional investors. How is the cost of preferred stock calculated? The cost of preferred stock is calculated by dividing the next dividend to be paid by the current market value and subtracting the flotation costs. What is the primary advantage of issuing preferred stock for a company? The primary advantage of issuing preferred stock is that it allows the company to raise capital without diluting voting rights. What is the main distinction between cumulative and non-cumulative preferred stock? The main distinction is that cumulative preferred stock accumulates unpaid dividends for future payment, while non-cumulative preferred stock does not accumulate unpaid dividends. How does preferred stock differ from common stock in terms of asset claims during liquidation? Preferred stock has priority claims to assets over common stock in the event of liquidation.